Hello everyone, welcome back to FinStack Academy. I am CA Uday Elchuri, and in today's video, we are going to understand one of the most important concepts in Oracle Fusion Financials, Subledger Accounting, commonly known as SLA. If you are learning Oracle Fusion, you have probably noticed something interesting. Users working in modules like Payables, Receivables, Assets, Inventory, Cash Management, or Project Accounting rarely create accounting entries manually. Instead, they simply perform business transactions. And somehow, Oracle automatically creates the debit and credit entries in the background. So naturally, a question comes to our mind. Who actually creates those accounting entries? More importantly, how does Oracle know which account should be debited and which account should be credited? That's exactly what we are going to understand in today's session. By the end of this video, you will not only understand what SLA is, but also why Oracle introduced it and how it works behind the scenes. So let's get started. Here is what we will cover today. We will begin by understanding the two different approaches Oracle uses to create accounting entries. Then we follow the complete accounting flow and understand how SLA generate accounting entries. Next, we will understand why every ledger is associated with a subledger accounting method commonly known as SLAM. We will then look inside a SLAM and understand its internal architecture. By the end of this session, you will have a solid conceptual foundation before you start learning SLA configuration. Let's begin. Before we understand SLA, let's first understand how accounting entries are created inside Oracle Fusion. Suppose your company has received a supplier invoice for office rent worth $5,000. There are two different ways the same business transaction can be recorded inside Oracle Fusion. Let's start with the first approach. Approach 1. Recording the transaction directly in the General Ledger module. Here, a General Ledger accountant navigates directly to the General Ledger module. Instead of recording the complete business transaction, the accountant creates a manual journal entry. The accountant manually decides which account should be debited, which account should be credited, enters the journal amount, reviews the journal, and finally posts it. In this approach, Oracle records exactly what the accountant enters. Now notice something important. Although the accounting impact has been captured, the General Ledger contains very limited information about the underlying business transaction. For example, it doesn't typically capture details such as supplier name, supplier site, invoice number, payment terms, due date, invoice line details, etc. The General Ledger focuses primarily on the financial impact of the transaction. Now, let's look at the second approach, recording the same transaction through Payables Subledger module. Instead of entering a journal entry into the General Ledger module, an accounts payable invoice specialist records the supplier invoice in the Payable module. This time, Oracle captures much richer business information. The AP user records supplier, invoice number, invoice date, invoice amount, description, etc. The AP invoice specialist is not creating an accounting entry. The user is simply recording the business transaction. The user never selects the debit account or the credit account. Yet, when the transaction is completed, the accounting entries automatically appear in the General Ledger. So naturally, the next question becomes, who actually creates those accounting entries? Let's find out. Let's now follow the complete journey of a business transaction. Everything begins with a business transaction. For example, a supplier invoice, customer receipt, asset addition, goods receipt, or a material issue. These transactions are entered in their respective subledger modules. At this point, Oracle has successfully recorded the business transaction, but no accounting entry has been generated yet. Behind the scenes, Oracle executes a process called create accounting. The create accounting process identifies all eligible business transactions and passes the required transaction information to the SLA engine. This includes information such as application, event class, event type, ledger, transaction attributes, etc. The SLA engine then evaluates two important inputs. The first input is the business transaction itself. The second input is the accounting rules that are configured within Oracle. Using these two inputs, the SLA engine determines which account should be debited, which account should be credited, and creates the accounting entries and transfers them to the general ledger. Finally, the general ledger becomes the single source used for financial reporting. At first glance, it may look like the SLA engine has only one responsibility: to generate accounting entries and transfer them to the general ledger. But in reality, the SLA engine is far more powerful than that. Think of SLA as Oracle's accounting brain. Every organization has its own accounting policies. Some companies expense an item immediately, others capitalize it as an asset. Some derive expense accounts based on the supplier, others derive accounts based on the cost center, business unit, inventory organization, or project, or even sometimes combinations of multiple business attributes. Oracle doesn't hardcode these accounting decisions. Instead, it allows organizations to configure sophisticated accounting rules inside the SLA engine. When a transaction is processed, the SLA engine evaluates those business rules, determines the appropriate accounting treatment, and creates the debit and credit entries. Finally, transfers them to the general ledger module. So, although the visible outcome is an accounting entry, the real power of SLA lies in its ability to support complex business-specific accounting treatments without changing the Oracle application code. That's why SLA is considered one of the most powerful accounting framework within Oracle Fusion. Now we know how Oracle generates accounting entries. The next question is, where are these accounting rules stored? The answer is inside a subledger accounting method commonly called SLAM. Every primary ledger in Oracle Fusion is associated with an accounting method. Think of it this way. The ledger tells Oracle where accounting is maintained. The accounting method tells Oracle how accounting should be generated. Whenever the create accounting process runs, Oracle first identifies the ledger. It then checks which accounting method is associated to that ledger. Finally, it applies the accounting rules defined within that accounting method. Now, let's understand why Oracle designed it this way. Many organizations operate across multiple countries. For example, they may maintain separate ledgers for the United States, India, Germany, or the United Kingdom. Although the business transaction may be exactly the same, the accounting treatment can be completely different. One ledger may follow US GAAP, another may follow IFRS, another may need to comply with local statutory accounting requirements. By associating a separate accounting method with each ledger, Oracle allows every ledger to have its own accounting rules. The business transaction remains the same, but the accounting treatment can vary based on the requirements of that ledger. Now, let's open the accounting method itself. Notice that a SLAM doesn't directly store debit and credit accounts. Instead, it contains journal entry rule set assignments. Every Oracle application such as Payables, Assets, Receivables, Cash Management, and many others has its own journal entry rule sets. Each rule set tells Oracle how accounting should be generated for a specific business event. So you can think of a SLAM as the central repository that organizes and manages the accounting rules for all Oracle Subledger applications. Let's now understand the internal structure of a SLAM. At the top, we have the ledger. the ledger is associated with a subledger accounting method. Inside that accounting method, Oracle assigns journal entry rule sets for different applications and event classes. For example, application payables, event class invoices, and journal entry rule set is accrual basis. Each rule set is made up of several configuration components. Journal line rules determine which journal lines should be generated. Account rules determine which general ledger accounts should be used. Description rules determine the narration that appears on the accounting entry. Supporting references provide additional information for reporting and analysis. Whenever the create accounting process runs, Oracle follows this hierarchy, evaluates the configured rules, and automatically generate the accounting entries. That's the complete architecture of Oracle Fusion Subledger Accounting. Before we conclude, let's quickly recap what we have learned today. We understood the two approaches for creating accounting entries in Oracle, how business transactions are recorded in Subledger modules, the role of the create accounting process, how the SLA engine generates accounting entries, why every ledger is associated with a Subledger accounting method, what's inside a SLAM, and the internal architecture Oracle uses to derive accounting entries. I hope this session has given you a strong conceptual understanding of Oracle Fusion Subledger Accounting. If you found this video useful, please like, share, and subscribe to FinStack Academy for more Oracle Fusion financial tutorials. Thank you for watching. I'll see you in the next video.